Welcome to another episode of our video series of the critique of modern systems.
Hey there. It's good to be back.
Good to have you. Are you ready for this one? Because it feels like we're trying to untangle one of the biggest financial questions out there right now.
I am. And you're right. This has, it's gone way beyond just financial circles. It's what people are talking about everywhere.
It really is. Everyone seems to have a story, right? A friend of a friend, a neighbor who took some like tiny investment and just it exploded into life-changing money.
Right. Overnight. And that's the real puzzle.
That's exactly it. Because when you hear about these 50x, even 100x returns happening all the time, well, basic economics kind of screams that that's impossible. If that many people are making money from pure speculation, somebody has to be losing. It's supposed to be a zero-sum game.
That's the core tension. And that's what we're going to unpack today. We're going to look at the forces behind this, the tech, the money, and maybe most importantly, the human behavior that created this, $5 trillion market?
And figure out where the real risk is for you, the listener.
Exactly.
Okay, so let's start at the beginning. We have to talk about the technology itself because I think it gets unfairly tangled up in all the speculative hype.
That's a crucial distinction to make. At its heart, the technology is blockchain. And if that sounds overly technical, just think of it this way. The internet we all use, it's built for copying things.
Right. Data is infinitely replicable, instantly.
Exactly. Blockchain is the opposite. It's built for uniqueness.
So it's like a giant public ledger that can't be changed. It proves that a digital file, whether it's art or data or whatever, is the one and only original, like we see with NFTs.
That's a perfect analogy. It's about trust and certification. And, the sources show that most of the early cryptocurrencies were actually designed to solve real problems with that trust.
Like what kind of problems?
Maybe a coin built to track a supply chain, or one designed for, say, instant low-fee transactions for international tourism. They had a job to do, a real function.
Okay, so here's where it gets interesting then. The whole issue seems to start when that asset, that useful tool, moves from solving a problem to just being traded on an exchange.
That's the pivot. It shifts from utility to the open market.
And its value completely detaches from its original purpose.
Completely. It's not about how well it does its job anymore. It's about market sentiment. It's about what the crowd thinks it'll be worth in 6 months.
So let's go back to the paradox then. If there's no central bank, no company, no state backing its value, who takes the loss when someone makes a 100x return?
Well, the loss isn't sitting on a balance sheet somewhere like, traditional government debt. It's all rooted in collective perception.
Like a game of hot potato.
That's not a bad way to think about it. The value is just the difference between what the buyer thinks it's worth and what the seller thinks it's worth. So if you buy at $49,000 thinking it's going to $5 million.
And the next person will only buy it from you at $30,000.
That's the loss. That shifting belief is where the volatility comes from. The loss is carried by the last person holding on when that perception collapses.
It almost sounds like a vast global casino. But in a casino, the house always wins. Who's the house here?
Functionally, it's the exchanges themselves. They are profiting constantly, massively.
Because they get a fee from every single transaction.
Every single one. Millions of them happening all over the world every day. It doesn't matter to them if the price goes up or down. They are monetizing the churn, the volatility itself.
Okay, so that explains the micro-level losses. But for this market to reach a $5 trillion scale, the fuel for that fire had to come from somewhere massive.
It did. And that brings us to global monetary policy, specifically everything that's happened since about 2010.
Right.
So the 2010s kicked off with central banks, the Fed in the US, the ECB in Europe, trying to tighten the money supply. But it didn't work. They couldn't hit their inflation targets.
So they did a complete 180.
A dramatic pivot. They shifted into massive quantitative easing, QE.
A term we hear all the time. But it's basically just injecting huge amounts of money into the system to ease liquidity.
It is, but the sources really stress that it wasn't just about printing money. It was the accessibility of that cash and credit that changed everything. And then, of course, the 2020 pandemic hit.
And that just pushed QE to its absolute limit.
To its ceiling, yeah. Governments were sending out direct cash payments, deferring taxes, offering historically cheap credit. It was a flood of traditional centralized cash into the global economy.
Trillions of dollars. And all that excess capital had to go somewhere.
It had to find a home.
Now, normally, in times of uncertainty, you'd expect a rush to a safe haven, like gold. But the data shows that's not what happened in the last couple of years, is it?
Not at all. The bulk of it flowed overwhelmingly into two very volatile places: speculative stock markets, and you guessed it, crypto.
So the $5 trillion balance isn't just some organic tech boom.
Not even close. It's the direct result of central bank policy creating this massive, desperate search for yield. People had all this cash earning 0% interest, so they started taking bigger and bigger risks to get a return.
So we've got the tech, and now we've got the fuel. Let's talk about the engine, the human psychology, because that flood of money alone doesn't explain the almost religious fervor you see in this market.
You've hit on the most critical piece of the puzzle. It's the constant messaging about an inevitable future. You hear it all the time. The Metaverse, the Singularity, projections of Bitcoin hitting millions of dollars.
It creates this intense pressure.
It does. We call it future fetishism. The idea is that you're not just investing, you're buying a piece of the future. And you have to buy it now or you'll be left behind.
How exactly is that sold to people?
Well, the marketing frames it as an act of foresight. Influencers, project leaders, they use language that makes traditional assets seem obsolete, like they're from a bygone era. It makes you feel like you have to participate in your own technological destiny.
And nothing pushes that button better than the fear of missing out. FOMO.
Oh, it's the primary driver. You hear these vivid, constant stories about your peers. The guy who turned $3,000 into $820,000.
That story becomes social proof.
Immense social proof. It legitimizes taking what is, objectively, a huge risk. The existence of these jackpot wins makes it feel rational for other people to jump in and, well, essentially gamble.
And it gets tied up in identity, doesn't it? Especially with younger digital native generations.
Absolutely. Participating is framed as being part of the future. If you don't, you risk being seen by your peers as, out of touch, a failure to keep up.
So the belief itself starts to drive the market.
That's how you get to the self-fulfilling prophecy. The collective belief in this guaranteed future success causes everyone to act as if it's already a done deal. And in financial markets, if enough people believe something and act on it,
For a while at least, it can become true.
the collective delusion becomes the market's operating rule. For a time.
Okay, let's pivot a bit to the bigger systemic risks. The data on geopolitical adoption is, it's not what I would have expected.
It's deeply counterintuitive. The highest adoption rates are not in stable, wealthy economies.
Right.
The sources show a really strong correlation between high crypto adoption and countries with extreme local currency volatility and low trust in their own institutions.
So we're talking about places like Nigeria, Vietnam.
The Philippines, Turkey, those are the top countries for opening new crypto accounts.
But why would people in an unstable economy run to an asset that is famously unstable itself?
Because it's all relative. When your local currency, like the Turkish lira, can lose a huge chunk of its value against the dollar almost overnight.
Holding a volatile digital asset might actually feel safer.
It's perceived as a safer hedge than holding cash that you know for a fact is collapsing. It's a flight from local instability, paradoxically, into global volatility.
That dynamic must pose a real challenge to state power, which depends on something called the seigniorage effect. Can you break that down?
Sure. Seigniorage is the power a country has when its currency is the world's reserve currency, like the US dollar. It means the US can print dollars, and the rest of the world basically has to accept them for oil, for trade. It gives them huge economic leverage.
So if crypto becomes widespread, especially coins that aren't tied to the dollar, that power starts to fade.
It directly diminishes it. If people all over the world can bypass national currencies and use a decentralized coin for trade, the state loses a massive amount of control over its economy and its global standing.
And the big question is, will they let that happen?
Exactly. Will nations, especially the US, be willing to just give up that power? Or will they eventually regulate or even try to clamp down on it?
And the fact that there's no clear regulation right now just adds to the risk. I mean, who legally owns a piece of digital land in the metaverse? The rules are completely ambiguous.
They are. And we've already seen what happens when a major state acts. When China banned crypto mining, it caused an immediate, massive disruption to the entire global market.
So no matter how decentralized the tech is,
At the end of the day, the world is still run by nation states, and their collective attitude is what's going to determine the long-term stability of this whole system.
so to pull it all together for you, the listener, the paradox of everyone winning is really being fueled by three powerful forces all hitting at once. You've got a massive centralized flood of cash from QE.
Meeting a decentralized, highly volatile technology.
And the whole thing is amplified by these universal human drivers, FOMO, and this obsession with buying the future.
It's a market driven by belief, not by production. And the story is much more about human psychology and monetary policy than it is about the technology itself.
Which brings us to the final critique of our modern system, based on that initial observation of these massive speculative profits.
Right. If the value of money is becoming totally detached from actual work, from production, and you can turn a few $1,000s into hundreds of thousands through pure speculation, what does that do to the global labor market?
What happens when the incentive to work is replaced by the incentive to gamble?
Exactly. When an entire generation realizes it's easier, or at least seems more lucrative, to chase digital wealth than it is to pursue physical employment, then we're facing a really fundamental crisis of value. What does our system even mean at that point?